Welcome to Chapter 7, the Financial Statements. Chapter 7, Essential Outcomes. When you're done, you should be able to create and interpret financial statements for a service proprietorship by identifying accounting concepts and practices related to financial statements, preparing an income statement and analyzing an income statement using component percentages, preparing a balance sheet for a service business, and connecting key terms in the chapter with application. Welcome to 7-2, Accounting Terminology. The balance sheet is a financial statement that reports on a specific date the financial condition of a business. Financial condition is often referred to also as financial strength. The balance sheet reports the accounting equation, assets equal liabilities plus owner's equity. If you look at the balance sheet, this balance sheet is part of the section on the worksheet. The balance sheet has the listing of all of our accounting equation accounts. We have cash, petty cash, accounts receivable, supplies, prepaid insurance, account payable, capital, and drawing. In the columns 7 and 8, you have your dollar amounts. These amounts are going to be transferred over to our actual balance sheet financial statement. The heading of a balance sheet is very similar to the heading of an income statement with one exception. Notice that the third line where we record the date, instead of writing for the month ended, we're going to write August 31st, just the date. So first we will center the name of the company on the first line. We will record the name of the report, which is the balance sheet, and then we will write the specific date. We are now going to set up our sections for the balance sheet. On the left side of the balance sheet, on the center, you are going to write the word assets. Notice that the first letter is capitalized. The second step will be to record the account titles up against the left wall. Notice that you need to spell out the entire accounts with the exception of accounts receivable. Our third step is to record the asset amounts. The fourth step is to go to the right side of the worksheet, the balance sheet, and center the word liabilities right across from the asset line. Then we will record our individual accounts payables. And again, you can abbreviate accounts payable A/P. We will then determine our liability amounts by drawing a single line showing that we are going to add all of the information above the line. Then we will write the word total liabilities, and then we will record the total of the liabilities, in this case $250. It is now time to determine our owner's equity section on the balance sheet. After we write the word total liabilities, the next line will have the title owner's equity, and it will be centered on the balance sheet. Then we will write Kim Park, capital, August 1st, up against the left wall, and to the left of the dollar amount column, we will write $5,000. Then we will write the word net income. And to the left of the $5,000, we are going to write $2,099 since that was our net income. Then we are going to record our drawing. So we're going to write the words less Kim Park drawing. And right underneath our net income, we are going to line up by tens, hundreds, thousands. Our net loss was, or our drawing account was $625. Then we are going to draw a single line, and we need to find the difference between our net income and the amount of money that Kim Park withdrew during the month. We will then record that difference underneath the $5,000 that we had for our original capital account. Then we will draw a single line, and then we will, on the next line, write Kim Park Capital August 31st. What we're trying to do here is we're trying to determine our new September 1st capital balance. And we do this by taking our beginning capital August 1st balance, adding in the net income, subtracting the drawing account, and that should give us our new capital balance. So if we look at our August 1st balance of $5,000, and then we look at the difference between our drawing and our net income, which is $1,474, we are going to add the two together to find our new August 31st capital balance, which will be $6,474. Then we are going to write on the next line total liabilities and owner's equity. And determine our total liabilities, we will add our August 31st capital balance of $6,474 to our total liabilities of $250. Our new total liabilities and owner's equity is $6,724, which is equal to our total assets. So let's take a look at how this whole worksheet, or how this whole balance sheet. On the left side, we have the listing of our assets. We have a total of $6,724. Notice that we drew a single line after the last asset account. We wrote the word total assets. We then compared our totals of $6,724 for assets to our total liabilities and owner's equity of $6,724. They are in balance. So then, since assets equals liabilities plus owner's equity, we will double rule both our total asset amounts and our total liabilities and owner's equity amount. In summary, the income statement is created first and determines income or loss for a business. The balance sheet is created after the income statement. It balances out the accounting equation. The income or loss on the income statement is added or deducted to the capital account. The capital balance should equal, on the balance sheet, the balance in the general ledger capital account. 7-2 work together. It is now time to go back to our accounting book to page 192. You will need work together page 147. If you need assistance, please let me know. When you finish page 147, please return to this PowerPoint. Congratulations, you have just finished both PowerPoints for this chapter.